When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Vogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Vogan. And now here's Jeff Vogan and Jeff Shea.
Thank you so much. Welcome to Premier Retirement, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about the retirement playbook changing in 2026, also listener questions, and finally, what does a Premier Retirement roadmap actually look like? My name is Jeff Shea. As always, I'm just here to ask the questions, but the words of wisdom and solid advice, they come from Jeff Vogan, founder and president of Premier Retirement Planning and Wealth Management. Jeff, how are you doing today?
Doing great. Always good to be with you.
Always good to be with you, Jeff, and always great to be with the people here of the greater Tucson area. Jeff, let's dive in today. The headlines are basically saying retirement rules are changing in plain English. What is different about 2026?
Well, I mean, every year something's going to be different. I mean, as we evolve through life and as we get older, sometimes our risk tolerance changes. Sometimes expenses come up or we get a little closer to, oh, my health is failing. Maybe I need to consider assisted living or just kind of different budgeting items. I mean, there's always something different to look at from the standpoint of personal reviews and just have a nice reset. We typically do tax planning reviews at the end of the year because we want to make sure that we do the right amount of Roth conversions, things like that. But at the beginning of the year, it's a good time to basically review your plan, see where you are, see what you want to do this year, and kind of bite off the plan. The Premier Retirement Roadmap is really kind of a year-by-year basis. It doesn't mean you can't look at it every day, but I think we just kind of have to see how the year went, see what we need to do, see what we need to change. As far as the markets, politics, and everything else goes, we're going to get a new Fed chair, looks like. I don't know that that's going to help or hurt situation. I think it's a lot more in line with what Trump wants to do. I think it's going to go back to printing money and stimulating the economy, which is inflationary in nature generally. So we'll see if somehow they can mitigate that while they pump money into the economy and make the economics grow. I mean, they want to grow it by 15% instead of what the 2 or 3 that it's been growing. I think that's a big ask of the economy and of the Fed chairman and of the money system and so forth. We have banks right now, just because of increasing interest rates, are shedding dollars, basically shedding treasuries and things like that. And there's this big sky is falling cry from the news that, oh my gosh, central banks, all the banks are getting rid of the dollar. They're going to drive the dollar down. No, they're just rebalancing the balance sheet based on interest rates and things. Interest rates have maintained kind of a higher level than expected, anticipating some rate decreases on the short term, which we got. Long-term interest on bonds have not really followed suit like they have in the past or like they expected to. So, the bond market really still kind of stinks. Not really a super good play to go in expecting that the bond market's going to go shooting to the moon again, because interest rates are going to go from 4 or 5 down to 0 again, like they did over the last 20 or 30 years before this interest rate spike starting in 2022. You have to be a little bit more mindful of bond interest rates. I don't think it'll be that much. We're in America, we deal in dollars, and the value of the dollar is not a sky is falling type discussion unless you expect to convert your assets into yen or marks or some other currency. But in reality, I know there's certain aspects of economics that it plays into, but I think people give it a little bit too much worry about that type of a thing. I think what we need to worry about is just what are they going to do to stimulate the economy? Are they going to create more money and make rich people richer and the poor people stretched more and more, keep interest rates up to where the middle class and the lower class can't buy anything? There's a lot of economic policy that I think over the years and even still separates the classes, makes the rich richer and the poor poorer. So that really hasn't changed, but that's still ongoing. We've got a stock market that's even more overvalued than it used to be, unless you consider that maybe tariffs are starting to work. Maybe some of the smaller companies in the U.S., domestic companies that are not part of the Magnificent Seven, the top 7 or 8 stocks in the S&P that drove everything, which are typically international tech stocks that drive the economy everywhere. The Microsofts, Amazons, Meta, Google's, Tesla, NVIDIA, and so forth. They're having some struggles, I think, maintaining the growth rates they used to. And so what we're seeing is finally, the rest of the S&P starting to pick up. We actually have some earnings catching up. Now, I don't think it justifies the overvaluation of the stock market that we've been at for some time. And I still think that the market's going to have some sort of a correction period. Now, if it can kick the can down the road and not correct and not get down to somewhere near fair value, which is historically fair value, kind of a historical medium temperature market where earnings kind of justify the prices. We haven't seen that in years. So if we look at the indexes and we look at history, we'll probably see some softening, or if Trump's right and he can stimulate the economy and make all the domestic companies that are small, mid-cap, and some large cap that aren't the Magnificent Seven or the Fab Five or whoever those stocks were in the last few years that have really dominated the market, if we can see them come up, maybe the valuations will start being more justified. The thing is, it really kind of means that we might have a stagnant or a choppy market going forward. So some of the things that have changed are really not changing. They're just continuing kind of in the same direction, just getting a little bit worse. I think if you're risk averse, you need to rethink it even more now because the markets, I think, are continually getting riskier and riskier. I think if you've taken the ride on gold and silver, that is obviously different now when you have to buy gold at over $5,000 an ounce and silver around 100. Things have obviously changed since last year. I mean, do you want to invest now? Are you buying high? Are you buying just kind of mid-range because silver's going to 200 and gold's going to 12,000? That's what some people are saying. I don't know. I don't have a crystal ball, but I do know that anytime you invest in anything, you better have the stomach to risk the big swings. I mean, we saw silver and gold sell off a couple of weeks ago, and it's still kind of iffy whether or not they're really going to continue that rebound uptrend. It's tried a couple of times and sold off a little bit, and it's still kind of in a choppy market. I mean, long-term trend's still up, but short-term trend's still kind of choppy. We don't know. Bottom line is the things that have changed, or maybe we're starting to see earnings come into the smaller companies and maybe support some of the overvalued stock prices. But then again, the stocks in the Russell 2000 are those, the Russell 2000 includes a lot of the stocks of the S&P 500, and the Dow, which is only 30 stocks, don't include, and really give us a better flavor of how the economy and the market's doing. The Russell's been the best performer so far lately, and I think that bodes well for, I guess, positive outlook for the economy. So maybe we'll get some fundamental support in the market, which we haven't seen in a while. But again, I don't think anything's really changed as far as the way we plan or the way we see things. We always only take risks with the money you can afford to lose. We try to grow assets responsibly, again, with the money that you don't need every month for income. We want to make sure your income is set. We want to make sure there is some sort of a gauge for inflation or other things that might impact your income or your livability, your lifestyle needs or wants. Sometimes Social Security, even though it gives a cost of living adjustment, may or may not be as much of a part of that plan. And other people want to spend more money in their earlier decade or two in retirement rather than later on. And so maybe the inflation factor isn't that big of a deal, because after a while, you're only worrying about the staples, the things that like just food and gas and taxes. Maybe you don't have a house payment anymore. You don't have big travel bills and big goals of traveling the world and riding in cruises and airplanes first class and spending a ton of money. Everybody's got kind of a different stage in their retirement planning. Some of those pre-retirees are still kind of figuring out, okay, if I go into retirement, can I afford to lose X amount of my assets and still weather the storm without having to go back to work and get a job in my 60s or 70s, or have to dial back on my wishes? Do I have enough to retire on? All those questions are not different than they were last year. They're all valid, and they're all something that everybody has to take into consideration. But I think in a new year, let's reevaluate where you are, where you want to be, whether the plan that you had last year worked or didn't work, or to the extent that it beat expectations. How do we incorporate that into the future? Do we just let that be a buffer, or do we raise your expectations or raise your lifestyle? Everybody's got kind of a different angle on retirement. Some people want to just save everything, live frugally. They've done a lot of fun stuff, and maybe they just want to leave a bunch for their kids and just grow it long term. Depending on your goals, you may or may not see this year as different than last year. Again, I don't see too much changing fundamentally. Things are at least stable. We're not in a super hyper inflation period like we were a few years ago. That seems to be tamed. I don't know if this push to stimulate the economy is going to reverse that trend and make inflation be a bigger part of the deal. But we'll wait and see. The bottom line is we have to kind of bob and weave and move based on what the current situations dictate. And I don't think that there's been enough changes from last year to this year that I'm overly worried or I'm going to be overly aggressive in trying to jump on certain things. Now, we do have a couple of tax breaks with Social Security for certain levels of income earners. Many of our retirees aren't going to see anything. Some of our clients are going to see some benefit. And some people that are planning on those kickbacks on taxes on Social Security may or may not realize them, because Trump's only going to be in office 3 more years and those things could be reversed. Who knows? The law is only the law as long as the people that put it in place are still in place and supporting that. You never know. But again, we always work with what's current. We see the things that are current. Not much different than we saw last year. We still think that there's a high level of risk in the market. There's a high level of vigilance in managing our portfolios. It needs to be, and you need to be very in touch with your risk tolerance, your income plan, the satisfaction and the confidence you get knowing that income is going to be met month after month, year after year, that you're not going to be overpaying in taxes, that you're going to be in a place where should something horrible happen, a catastrophic illness or something, that your insurance or buffer is going to cover that, long-term care, some sort of a plan for that. make sure that's a legacy plan so that if something does happen to you, that your assets to transfer those you love without any trouble. So these are all the different things. And this is why you have to come and see me or somebody like me anyway. The reasons are no stronger or more pressing this year than they were last year. Just things are slightly different, but I don't see our focus changing. I don't see our planning process changing. I just see us looking at the current situation to make the best of it.
We're talking with Jeff Vogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. We're talking about planning here in 2026, the fact that it is not too much different than 2025, but it probably is a little bit different than it was maybe in 2020. How do we plan for taxes with Trump only being in office here for the next, I'm going to say 3 years or so?
Well, I think anytime there's an opportunity to reduce your future tax bill, regardless of what those taxes are, and I think taxes are going to eventually go up. I just don't think politicians do math correctly. They don't do math in an economic standpoint like Donald Trump does. He can lower taxes, and it just means people have more money to spend, which means the economy grows, and the people that have those businesses that are growing the economy have more money to spend, and it's the circle of monetary life. The momentum of money increases with lower taxes. Politicians don't understand that. They just do math, say, oh, well, we want to spend this much, so we better go take it from our taxpayers. They love us, and that's why they voted us in, because their money is our money, and we need to spend it. Sad and sick as it is, I think anybody who gets into politics ought to have some economics background, not just political science, how to screw over an election and win by doing corrupt pay-to-play schemes and all the other stuff they do to get elected. They don't understand economics. I'm glad that Trump is showing us a little bit of that. Tariffs haven't hurt us. Some people say they have, and they're putting businesses out of business. I think bad-run businesses are going to go out of business anyway, not because of tariffs. There's a lot of businesses that are thriving now because they're now competitive on the local manufacturing level where they weren't before. And we're seeing that in the stock market. And like I said in the last segment, how smaller companies are finally starting to show earnings that they haven't shown in a long time. And that's because we're getting on a more even competitive playing field. But again, Trump's done some things that have helped us economically. I don't like everything he does. Not everybody likes anybody, no matter who they are, everything they does. I think even a few Democrats might have not liked everything Biden did, although I doubt that, but it seems like they're all in on that one. But free thinkers are going to like the good stuff and not like the bad stuff. And right now I like the good stuff, the lower taxes, the stimulating of the economy. I don't think if you can keep inflation under wraps, I don't think it's bad to make liquidity and opportunity available for businesses and just the normal citizen to borrow money to get ahead. I mean, the only way the economy grows and scales to the level that it has in the past is, I hate to say it, but it is because of debt. I mean, it's because you can borrow and create economy now, pay for it later. It's not always the wisest thing. If you listen to Dave Ramsey, he'd say, oh my gosh, that's stupid. But you know what? This country would not exist and would not be able to give its citizens anything near what it does without the availability of capital, the availability of people to take smart loans to invest in their future, to invest in their homes, their businesses, and other things. So Trump is very pro-business economy growth. And I think for the next few years, we might see that. I also think the thing is that he made permanent, now we don't know how permanent it is, but the tax breaks that he put into place, 8 years ago or so in his first term that have extended. When he came into office, 9 years ago, and made that new tax law, the 25% marginal tax bracket started at $75,000 for a married couple, $75,000 and change. Anything over that money was taxed at a 25% tax bracket, and the top bracket was just shy of 40%. The tax bracket that ends at 24% is over $400,000 taxable income for a married couple, which used to be the 28 or in the 30s. It would have been well into the 33% or better bracket 6 or 8 years ago. So there's a lot of tax savings and a lot of opportunity for people to do conversions from their IRAs to Roth IRAs, to do conversions from their IRAs and tax-deferred accounts to accounts that are never taxed. I love LIRPs, life insurance versions of a Roth, which is like a Roth on steroids, where you actually get more income out of it over time, generally speaking, than the average rate of return on a Roth. Reason being, on a Roth IRA, you pay taxes on it now, it grows tax-free, but when you use it, you actually take it out of the account, and that account depletes. In a LIRP, you take money out of an IRA, you fund a LIRP, life insurance retirement plan, you actually buy a death benefit that's tax-free, you borrow against that death benefit, and all the cash you put into the LIRP continues to grow. So you never actually deplete the account by taking the money out. You just borrow against an ever-growing compounding tax-free interest account, which grows at a much higher rate than a municipal bond account, which some rich people think is the way to go because they have a high tax bracket, they don't want to pay taxes. Well, what if you can make 2 or 3 times the interest rate as you do on a municipal bond portfolio? You don't have the volatility and the risk of interest rates going up and down, which, by the way, municipal bond accounts have plummeted in the last 3 years because interest rates have risen. The LIRPs have not. The LIRPs have, by and large, done very well. So if you can average 6 or 8% on a LIRP minus the cost of insurance, in other words, the right to play the game, the tax game, you can actually do very well. So The Trump tax cuts have really made it a great time to do tax planning, to pay taxes now at 22 or 24% on up to $400,000 in income. So if you're making $200 a year and you're still working, you might even still think about converting to Roth or putting all your 401k contributions into a Roth in order to pay taxes right now at 22 to 24% rather than pay taxes later if those Trump cuts are reserved and we're paying taxes at 25% or 28% as soon as we get to a taxable income of around $100,000. Tax planning is a big deal. Our company has really grown exponentially over the last few years because of the Trump tax cuts and because of the focus that we have on tax planning here. We believe the math will prove whether or not it makes sense to do a Roth conversion now or wait till later. So many people think that when they're retired, they're going to be in a lower tax bracket. So it's better to get the tax deduction now and pay taxes later at a lower tax bracket. Well, how do we know the taxes are going to be lower? And first of all, the tax brackets probably aren't going to be lower. Not too much long after Trump leaves office. But the other thing is taxes are likely to go up. And when people have been such good savers the last couple of decades, especially those retirees that are retiring now that have millions of dollars in 401k or IRA money, when they have to pull that money out and it's mandatory in your 70s, you have to start pulling that money out. What's that going to be worth? What are those mandatory withdrawals going to do to your tax situation? You know, if Trump tax levels are not still in play and it goes back to the old rules, which it was already ready to sunset this year and it now has been extended, what if those tax breaks go away and you've got millions of dollars in IRA money that you have to take out and pay taxes on later at a much higher rate? It would be much smarter to pay it at a lower rate now and never pay taxes again. So we can help you with the math to decide if that makes sense. But I think the next 3 years, at least, we're going to really focus on our tax planning. We're going to really focus on making sure that you keep more of your money. It's not what you make on your investment so much. It's what you end up keeping. Some people think that I've made so much money on this Apple stock I bought 10 years ago, I can't ever afford to sell it because the taxes are too high. Well, guess what? The most you'll pay on taxes on that is 20%. And you could lose, maybe not Apple stock, but over time, you could lose money on stocks. Some of these older stocks that kind of get to be cash cow and then just kind of become competitive and stagnant. You know, why not take profits? The reason you invested is to take profits. By the way, the IRS is your partner in every investment you make because there's going to be a tax on the way out. When you want to divorce your partner, you want to divorce them now, pay those taxes and put it someplace where you never have to pay taxes again, or put it in a new investment that has a much higher upside. The next Apple, for example. Too many people are hung up on not paying taxes right now when sometimes the best idea is paying taxes now and never paying taxes again on that money or paying less later in the future. Bottom line, keeping more for yourself to spend in retirement, keeping more for yourself to give to your kids, your heirs, your friends, your family, whoever you love and care about, your charities, churches, whatever you want to do. Keep it in your control. Don't give it to the government because they just waste your money. I mean, we see all the fraud. We see all the corruption. We see just how the government treats our money like it's their money. They can just piss it away, pardon the French. But anyway, they see fit. And I think I'm a good citizen by helping our clients be good citizens by keeping your money in your pocket, in your community, spending it on things that help our economy and ultimately help your family, not the government that just throws it away on stupid things that hardly any of us agree with.
Jeff, good conversation here. I want to talk to our listeners for just a moment here. If today's conversation hits home, if you're sitting there thinking, I saved well, but I'm not 100% sure my retirement plan is built for this economy, then this is exactly the moment to get some clarity. Inflation is still biting, bonds don't behave like they used to, and too many people are heading into retirement with a plan that looks good on paper but doesn't hold up when life happens. If that's you, then Jeff Vogan at Premier Retirement and Wealth Management here in Tucson and Mesa is offering his retirement playbook at no cost and no obligation. To get yours, call 520-780-9059. It's 520-780-9059. This retirement playbook will help you preserve your wealth so that you can have a better retirement. It'll also help you create an income stream you can't outlive and reduce taxes. It's the Premier Retirement Roadmap, and you can get it right now by calling 520-780-9059. You can also find out more about us online at primrat.com. Jeff, time for a break. When we come back, we'll answer listener questions and more when our show continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Vogan and Jeff Shea.
Thank you so much for including us into your weekend. You're listening to Premier Retirement with Jeff Vogan, founder and president of Premier Retirement Planning and Wealth Management with an office here in Tucson and Mesa. Telephone number 520-780-9059 if you hear anything that piques your interest today. And a reminder for you, we're on the air for you 4 times a week, Saturdays at 7 a.m., 9 a.m., and 1 p.m., and also on Sundays at 11 a.m., and 24 hours a day, 7 days a week. We're also on our podcast. Go to wherever you get your podcast, search for Premier Retirement with Jeff Vogan. You'll find this show and all of our past shows so you can stay on top of your journey towards a confident retirement. Okay, Jeff, time for listener questions. Tim is listening to us in Tucson, and Tim says, I'm 67, retired, and we have about $1.8 million. I guess he's married. We're not overspending, but every time the market drops, I feel like we're one bad year away from ruining the whole plan. How do you build a retirement plan that still works if the first few years are ugly?
Well, you're talking about the critical years. I give an example of climbing Mount Everest. The way up is a long, hard road, one foot in front of the other. You got to be consistent to get to the top. It's kind of like retirement. You're working every day. You're saving. You're doing all the things right. You're spending less than you make. You're trying to mitigate taxes and not be silly in the way you spend your money. You finally get to the top, you plant your flag, and then you're off into retirement. There's a place on Mount Everest that actually they call the death zone because almost everybody who dies up there dies above that 26,000 foot level, which gives you about 3,000 foot left of Mount Everest. If you consider that death zone being kind of those last 5 years right before retirement and the first 5 years into retirement, we call those the critical years or the death zone years, where you can ruin a financial plan. So you're very much on track with what you're thinking. You're very close to your retirement date. I mean, you're still just getting going, and you could be just 1 year away from it. And by the way, on that example of Mount Everest, 80%, 4 out of 5 people who die on the way down, not on the way up. I think in retirement, it's the same thing. If you're going up the hill of retirement, the market has a really big correction and you're still working, then maybe you just put off your retirement date until you make that money back, or you kind of ride it out. At least you have a paycheck while the market does whatever it does, and hopefully it comes back. Now, the last 2 times we had major market crashes in 2000 and then again in 2008, both those crashes took about 7 years for the market to get back to even. So I don't know if that 5-year critical years is really a good standard, but as you get to those critical years, you have to remember to take profits and to make sure you secure those assets and make sure that they're there for you for the way down the mountain. I'll give you a couple more examples of why, as we're consistently investing on the way up the mountain or on the way to retirement, there's a thing called dollar cost averaging, where volatility in the market actually helps you, doesn't hurt you. In other words, every time the market dips, consistently every week or every month, every paycheck, putting money into the 401k and buying stocks. And by the way, while you're growing your assets right up until you're a few years away from retirement, you ought to be very aggressive, because the more volatile the market is, typically aggressive investments are a little bit more volatile in those down market cycles. You buy a lot more at a lower price, and then everything comes back together and you end up averaging a much higher annualized rate of return over the 3 or 4 decades you work than you would have if you just parked your money in the beginning and just saw what happened on a compounded annualized basis, which still would have been good if you had all that money up front, but you don't. You have to put it in systematically. So systematic investments work better when the market's volatile. However, on the way down the mountain, you don't have a paycheck paying the checks anymore. You don't have that ability to just let those investments ride. Most people are planning to use regular systematic distributions from those assets to live on, to pay those bills, to make up for that paycheck that you didn't get. I mean, if you're making $150,000 a year, $30,000 a year in Social Security isn't going to cut your expenses in retirement. You're probably going to need another 60 or 80 or 100,000 from those investments on a regular annualized basis to make ends meet like you're used to or like you plan to. What if the market goes down 20 or 30 or 40 or 50%? You have to sell twice as much of your investment capital in order to pay those bills, which is twice as much investment capital that doesn't grow the next time the market rebounds. So volatility is the exact opposite. It will actually make your rate of return be less over time while you're pulling money out than the average rate of return in the stock market. And that's one thing I think some people you might hear on the radio that act like experts don't understand about the difference between growing assets, being out of debt, and living within your means and saving on a regular basis. Don't understand when you pull that money out, the math is against you. When you're coming down that mountain, you're out of favor with the market. I always talk about the story of Norm, who was really the sad but true example of somebody that missed the boat and got some bad advice when he retired. He had $1 million in his 401k in the year 2000, decided to retire, and his advisor says, don't worry, Norm, the market average is 10%. You can take whatever you want out, 10%. You can live on $100,000 a year because you have $1 million. Well, he lived on $80,000 a year. He lived on actually less. And somehow in 3 years, his portfolio was down to $250,000, wondering like, how did this happen? Wait a minute, I'm only spending $80,000. I had $1 million. I spent about $240,000 over the last 3 years, and now I'm only worth $250,000. And the advisor still said, oh, don't worry, Norm, it'll come back. Well, guess what? The $250,000 that he had in there that went down, he was in the tech business and lost most of the money in tech stocks. The money that rebounded in tech stocks over the next 14 years, by the way, it took 14 years for the market to rebound and get back to even, all the while he needed to spend $60,000 or $80,000 a year from those investments, and he only had $250,000 left. So guess what he had to do? He had to go get Social Security early. He had to go get a job, try to not spend that money. And even though that the money grew back up to about $400,000 by the time 2007 and 8 came, all of a sudden he's into another market crash. I heard this story when he's 70 years old, wondering, Jeff, is there anything I can do? I feel like my world is over. Yeah, it is. You just crashed and burned. You died on the Mount Everest on the way down, and you're in that same position. So it's a very intuitive question. I'm glad you asked it. It really puts the story of Norm into perspective, true perspective, and helps us understand the significance of it. You know, if you're feeling a little gut ache about the fact that you've done really well and have a really nice savings, and know that if it goes down by 50% in the next market crash, and by the way, fair value on the S&P is somewhere in the 4,000 range, not 6,000 or 7,000 range where it is right now. So we've got a significant correction if the market goes back to what we consider fair value. And by the way, it has returned to that fair value many times, even after it's made a new market high. And we've set record new highs, but that's when the market crashes, usually after a new high. That doesn't mean it's going to tomorrow. We've been making new highs for a long time. The market does what it's supposed to, and it's supposed to get back to equilibrium value. We just don't know when it'll do it. It does it on the market's terms, not our terms. We have to keep that in mind. So if you're at all concerned, I would definitely pull money out of the market, put it in someplace safe. Not that is safe that pays no interest, but something that is safe that still goes up when the indexes go up and doesn't go up when the indexes go down. You know, what if you can make 10 or 12% if the market goes up and not lose any money if the market goes down? Now, granted, if the market goes up 20%, you still only make 10 or 12. That's about the highest we can get on a cap or on an upside of a stock market right now. We also have some participation rates where we make about 50% of whatever the market makes, but you don't make any of the losses. So if you want to preserve your assets, I will tell you that if Norm had put even half or 3/4 of his money in assets that protected the principal, he'd still be alive and well now. Well, he's probably alive, but he'd be financially a lot better off than he is now. I heard that story, unfortunately, in 2009. We parted friends. There's really nothing I could do to help him dig out of the hole when he needed to spend that money. I knew he'd just go broke a few years later, and he probably did. But I asked him if I could use that story, and he did. And I put it in my book, and I've shared it at seminars and events and explained to people why volatility in retirement is different than volatility while we're getting ready to retire. And just because Wall Street says it's cool to just leave your money in the market because overall the long-term gains are better than other assets, that's true. But when you're taking income from those assets, it's a whole new story. And that's the one that Wall Street seems to forget. I mean, after all, they don't want you to take income. They don't want you to deplete those assets, those holdings. They want you to keep it, buy it, hold it, set it, and forget it, and let them trade those stocks and manipulate it in their own as a market maker and as portfolio managers for their big institutional clients and pension funds. You know, they don't want you to be selling stock and using it for income. They just want you to keep letting it ride. And that's kind of their mantra. It's just, just hang in there. But why did you save it? You're going to eventually spend it. Why don't they come up with a spending plan? Well, unfortunately, they haven't. Guys like me, independent financial advisors that are fiduciaries and actually care about their clients and care about their income and care about the fact that they want to spend money and enjoy retirement on their terms, help out. The insurance company has gotten big into the business of retirement income. I mean, they've always been there. They've always been into the pension management and secure pension management funding. They've also created annuities that guarantee income. They've created life insurance products that give you predictable tax-free income even. I talk about LIRPs a lot. So there's all kinds of different ways that you could take profits and still get upside the market and create a plan where instead of being limited to 3 or 4% withdrawals from your millions or million or whatever it is you have saved, you're not limited to that rule of thumb of 3 or 4%. You can actually lock in somewhere between 6 and 8% guaranteed on, let's say, half or 3/4 of your money, have more guaranteed income forever and still have money to play with, still have money you can throw at the market, still have money that you can crash and burn on and not be derailed in your retirement plan because your income needs are met. So again, it's a more holistic approach. You got to consider the investments need to support income in retirement. They can't be left at risk unless you can afford to lose that money or wait on it for indefinite period of time. It could be 3 or 4 years, it could be 3 or 4 months, it could be 7 or 8 years like the last couple of big market crashes, which we're probably due for. And I've said this for a few years. Honestly, I thought it'd happen by now. I've said that. I'm wrong. It hasn't happened by now. Doesn't mean I'm wrong that it's not going to happen. In fact, I don't think I'm wrong that it's not going to happen. It will happen. I just don't know when. And we're going to be dialed into, when that happens, we're going to look forward to taking opportunities to bottom fish if it really crashes. But we're also going to not just write it down on our investments either. And the best way you can not write it down is get principal protected accounts that never go down so that we're not blindsided when the market does. I mean, we can get out of the market on the downtrend, but we can never time the exact top. That's not going to happen. The indexed products that are principal guarantees actually do sort of time the top. They lock in on an annual basis, sometimes on a more frequent basis, sometimes every couple of years, but you're going to be locking in the principal on those intervals. So long answer, very short question, very good question, but it's one that makes me very passionate about what we do in retirement planning, and that is secure the income. Don't let what your greatest fear is, and that is derailing your retirement by leaving too much at risk.
Tim, that's a very good question. And again, thank you so much for listening to us in Tucson. We'll send you out Jeff's book, Retirement, The Road Ahead. And again, if you'd like to further the conversation with Jeff, 520-780-9059 is the number, and you can make that call right now. Okay, Jeff, let's talk to Anthony in Vail. Anthony says, I'm 72 and my RMDs are forcing me to take more income than I actually need. It's pushing up my taxes and Medicare premiums. What are the smartest ways to reduce the long-term damage from RMDs without doing something risky?
Well, you don't have to do something risky. You have to do something that's going to probably feel like a gut punch, though. And I think that is decide whether or not you want to just pay all your taxes up front or over the next couple of years. There's a couple of, you might have just waited too long. Honestly, there might be a situation. I just did a plan for somebody that saved so much money. They live so well within their means. They both had really good jobs. Executive at a bank and a doctor, more than $10 million in 401k money. I mean, okay, they got a problem. Now, we can move all that out over the next few years and pay close to 40% combined tax bracket. And honestly, just based on pensions and other incomes and deferred comps and some of the stuff that they have, and they're probably still going to be in pretty close to that 40% bracket forever. It's really kind of a hard balance. I mean, some people get way out of whack because they just waited too long. I hope you're not there, but it might be that maybe you just need to move, let's say you just need to move $1 million out of tax deferred accounts, pay taxes at maybe 24% right now, and then stay in the 22% or lower bracket for the rest of your life. That math actually works in your favor. There's a couple of gut punches that are coming from there. That is, you got to pay a big check to the IRS. You hate it going out, but consider the savings that you get going down the road. The other thing is your IRMAA, the amount you pay for your Medicare is going to go up considerably when you do this plan. The thing is if you're in a new tax bracket where you already hate your income, have way more than you need, and I don't know what that number is, but you might be in a new IRMAA level as it is. So you might be already paying $300,000 or $400,000 or even $500,000 a month for your Medicare Part B, which I think is outrageous. I think it's really sad that the government decides to penalize the people that saved well, worked hard, have a bigger 401k than others because they lived within their means and didn't just squander their money. And all of a sudden they've done well. And now they're in retirement and they have to pay everybody else's Social Security because that's really what it is. It's a means tested Social Security payment. And you're paying for everybody who was either irresponsible, broke, or just didn't do as well as you did. It's totally unfair, but that's socialism in America. We thought we were a free country, but there's a lot of socialism going on, and I hope it doesn't get worse. But that's the way it is. If we want to buy insurance if you're working like me, you want to buy insurance on the exchange, you're going to pay for 6 families' insurance if you're in a high income, not just your own. All of a sudden, you have a higher taxable income. Now you get to pay double or triple for your Medicare premiums, even though other people don't. So keep that in mind as you make those plans to transition. Now, you might also find that even though you're bumped into a slightly higher tax bracket, you might find that it's better just to stay there rather than go into a new tax bracket, because for the rest of your life, you're at least going to be in that medium tax bracket where you're at. The reason we do tax planning is only because we see the numbers in your favor. And if we put your whole situation on one of our proprietary spreadsheet programs that we've developed over the years, which is basically our Premier Retirement and Tax Plan, we can see what the benefits of paying taxes now are compared to paying taxes later. We can even see what the next 30 or 40 years, depending on your age, would yield to you as far as net spendable income and net legacy income to your heirs, and show how much taxes you pay. Now, keep in mind, if taxes go up, that could all change. The more you pay taxes now at a rate that you understand and know, if you want to divorce the IRS from your future as being your partner that you're married to forever, if you want to get that divorce right now, it might cost you a chunk, but just like a divorce typically does, but maybe you move on in a happier situation. I don't know. The deal is the math will dictate whether it makes sense to do it or not. We can help you with that if you don't have a program or can't figure out whether or not the current tax situation is actually okay compared to what it might be. The other thing is, by kicking that can down the road, you might have already figured that out, is you might just continually get into a worse and worse position. If that's the case, let's just get to a worse position now and get it done with and move on.
Anthony, once again, that is a very good question. We appreciate you listening to us in Vail. And of course, you'll get Jeff's book, Retirement, The Road Ahead. Okay, Jeff, let's move to Gary, who's listening to us in Rancho Vistoso. And Gary says, a lot of retirees chase dividends, but I've heard that can backfire. If someone wants reliable income without loading up on risky dividend stocks or junk bonds, what does a smart income plan actually look like?
Well, it just depends. I mean, we have some dividend stocks. We have a portfolio that's all focused on dividends. Unfortunately, the dividend stocks last year did kind of stink. On most cases, they kind of retreated a little bit. And even those that pay high dividends barely made up the difference of what they lost in value. I remember one that was always given credit for being a great dividend stock, and it's changed a little bit lately, but AT&T, the symbol T, that stock paid a great dividend, 5 or 6, 7%. But over 5 years, it went down 50%, even though they paid a 7% dividend. So you still lost 15% net if you had to sell the stock. Now, you could just say, well, I'm going to hold it forever. Really? Well, I don't know. Has AT&T really been that good forever? I guess I could look at a chart and find out. I think it's rebounded a little bit because of DirecTV and some of the things that they've gotten into. But that's just one example of something that for 5 years, you just kept losing more money than it made. That's a bad dividend stock, in my opinion. Now, there are some ETFs that are pretty good at picking dividend stocks or have kind of a cross section of all the dividend stocks. And if you're going to just live on dividends and you don't care what the stock's worth, I guess that's okay. My opinion right now is good fixed interest is better. We've got some good dividend stocks in our portfolio, or dividend ETFs, that have a lot of emerging growth in foreign stocks right now, especially because of the dollar valuation issues. They're actually going up in value. And we've got some ETFs that have a 5 or 6% dividend, and they're up 7% for the year. So that's 12. If you look in the right places, you can get some good dividends and you can get some good interest. Some of it is bond interest. Corporate bonds are having to pay a little bit higher interest on good, solid investment grade bonds than a lot of dividend stocks. The thing is, dividend stocks can always change their dividend. A bond at least gives you back your principal when the bond term is over, and it pays a guaranteed interest. And if they're investment grade, I think that might be a better way to go than dividend stocks right now that interest rates are up. I think dividend stocks are a little bit more appealing when interest rates are around zero, when the company has a chance of growing and having profit because they're not having to pay big money to borrow, and they can actually pay a dividend that beats the current interest rate. But there's a lot of things that you can buy. Again, there's some companies that are growth oriented and reinvest all their money, and some companies that are so big that even if they pay a dividend, they're really not going to grow much more. They can't really put money into their company and grow because they've either got kind of hit the area of where they're diminishing returns and so forth. But I see dividend stocks as just like any other stock. You got to pick them right. You got to watch them. You've got to be in them as long as they're holding their value, not when they're losing value. We've got some dividend stocks. One that some people really like is, I don't know, there's like IBM and Microsoft and some of these stocks that pay like 2% or less in dividends. Like, that's not really a dividend stock, in my opinion. When you have a better chance of growth opportunities, or you see the company thriving in a new market, maybe taking advantage of AI or things like that, that'd be why I buy them, not necessarily for the dividends. Most people buy the dividend stocks on companies that are kind of flat to stagnant, don't really have a lot of growth options. And what that means to me is they probably have a lot of downside potential, and I think you should avoid them. So be careful in the dividend stocks. I'm not a dividend stock buy and hold forever because the dividends are always going to be there guy. I've been burned by that too many times in the last 30, 40 years when I've tried it, even though some of my older clients that have lived on it since their dad and grandpa all bought GE in the 30s and 40s and hung on to it because it never missed a dividend. Now GE is more of a growth stock than a dividend stock. Times change, philosophies change. The reason we bought dividend stocks a long time ago were way different than the reason we would buy dividend stocks today, in my opinion. I just want to buy stocks that make money. I don't care if it's a dividend or it's growth. I just want to make money. I want to buy stocks that go up, not down.
Gary, very good question. Thank you for listening to us in Rancho Vistoso. And again, if you'd like to further that conversation, call Jeff at 520-780-9059, and we would love to talk to you. Jeff, let's talk about the last thing that I want people to know about today, and that is what a Premier Retirement Roadmap actually looks like. When people call 520-780-9059, make that appointment with Shelley and actually come into you, what can they expect?
Well, first of all, we're not a one and done. Let's see your situation and see if we want to work together and try to close you on a first visit. I think that's ridiculous. I think it's stupid. And I think if you value your money in a relationship with an advisor, which we're kind of old school that way, we value the relationship as much as we value the opportunity to serve and make your life better. But plan on a few visits. Don't plan on one and done. The first visit's a discovery of, we want to know if you're a fit for us. You want to know if we're a fit for you. We'll talk about philosophy. I'll talk about your philosophy. I'll mention a few things about us. But yeah, typically save the fire hose visit where I blast you with everything till the second one. And that's after we come up with some ideas as far as the type of investment alternatives, the type of income planning, the type of tax planning we would use in the second visit. But the first visit is really, we try to listen a lot. I'm good at talking, and I try to really put my listening ears on that first one to hear what you're saying and what you want. I get excited when I see a situation where somebody's in a basic Wall Street position, hasn't done anything outside of that. And I think, oh my gosh, there's so much more we can do to build this financial house. They don't even have a foundation. They just got a bunch of walls and windows, and they don't even fit. We want to build a house that's coherent, that makes sense, got a good foundation in it. We've got some growth potentials, and we got a good solid ceiling on there, roof on there that is going to help us weather the storms that come along. Yeah, we want to build a plan, but we want to build a plan based on your goals. I mean, we want to find out where your income is going to be. You don't have to bring in your statements and all that stuff the first visit. If you just want to get to know us, that's fine. And then we can do a second one if you want to do that. It's far more productive if you do have those things available, so that if you do decide to go with a plan, we can have that information, see how much you're paying in taxes that you shouldn't have to pay, see how much risk you're taking in a portfolio, even though the guy says, well, it's well diversified, there's not much risk here. Well, we can tell you, we've got a situation, it used to be called Riskalyze. It's basically a risk factor formula that'll tell you how much risk you're taking, what your risk number is compared to the stock market and compared to some of the investments that we might make for you. We can compare the future after if you should choose to go with us on a risk level. We're going to kind of peel the onion back and let you know some of the flaws that we see in your portfolio. We're also going to tell you the strengths. If you have a really good portfolio, we're going to tell you that. We're not going to just say everything you have is bad and ours is great. We like the good things people bring to us. We build on that. Most people bring to us a great foundation of savings and some investments. The problem is it's not maybe settled on, that foundation might be on a little bit of sand, not the rocks, right? So we want to make sure we firm that up. Then we take some time, we build a plan based on the things that we know over the last 30, 40 years that help people sleep at night and have confidence in their retirement. We build a plan that we've seen enough people that we've probably seen somebody just like you or very close to you and know what has worked for them based on similar goals, values, and situations. So we'll kind of massage that to a place where we think you're going to like it. We'll show that to you on the second visit. You say, oh yeah, I like this. I don't like this. I like that. Can we do more of this? I really like tax planning. Can we go really more tax heavy on the plan and not worry about risk so much and just really maximize my income? Whatever you want to do, we can tweak it from there. When you decide you want to move forward in the next visit or two, we'll do that. But we want to make sure that you're comfortable with us. The last thing we want to do is try to undo business when you're halfway down the road and you said, maybe this is not for me. So we want to make sure that we go through those steps, make sure that we know about you, we know about your family, we know about your income goals, we know how much you love or hate taxes, want to know how much you love or hate risk. We want to make sure that, you can come here and have a one-stop shop where we cover all the bases that you don't need. And we even have CPAs that do your taxes here. We have CPAs that do tax planning. We even can scrutinize private equity opportunities. Basically, all the tools at our disposal as an independent fiduciary company to help you make the right decisions based on where you want to go. And then we just basically pick the tools, show you the plan. If you like the plan, then we move forward. It's really simple. We hope that when you move forward, you'll love us forever, and we want to love you forever and be part of the family. We have very low turnover. I mean, somebody told me that turnover in our business is like 20%, and I don't think ours is even 1%. Once you get a plan and you see how it works and you see it working year after year, why would you want to leave? Even if the market crashes, if it's only crashing on 20% of your money because that's all you decided to have at risk, your income needs are met, your tax needs are met. You feel comfortable because you know you're not running scared that, oh my gosh, I'm going to run out of money. I need a new advisor. I need a new plan. This one doesn't look like it's working for me. We review that at least annually and more often if you want. We want to make sure that we have that annual checkup to make sure we're going in the right direction. If there's any changes, we want to make those changes. But bottom line is we work for you. We don't work for a company. We don't work for Wall Street. We don't work for a firm that tells us what to sell you. We let you tell us what you want, and we find the right product and service that will accommodate and solve that problem.
And Jeff, if our listeners would like to take advantage of the Premier Retirement Roadmap, come in and sit down with you. You can get it at no cost and no obligation by calling 520-780-9059. You can make that call right now. Leave your name and number. Shelley will call you back and set up that appointment. Again, there is no cost and there is no obligation. 520-780-9059. You can also find out more about us online at premret.com. Well, Jeff, out of time for this week. I want to thank you for your time. But again, most importantly, I want to thank our great listeners for joining us here in the greater Tucson area. So for Jeff Vogan, I'm Jeff Shade. Have a great weekend. We'll talk to you again next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. This show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy, and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.